Okay, so thanks so much for asking me to discuss this paper, Two Tales of Debt by Amir Kermani and Yueran. It's a really fascinating study, and I think you'll see that the conclusions, apart from the facts and like the implications, are a little bit open-ended. I feel like they can be taken in so many directions, and probably not surprisingly, I just sort of took it in the direction of things that I have thought about. So actually, even though this is, maybe packaged as a microfinance paper, I'm going to talk a little bit about the relationship between these implications and macrofinance, and we can get into the micro as the talk goes on. So these guys have really collected some super cool data, very detailed, from Chapter 11 findings on liquidation and going concern values. And they have some very convincing findings on capital structure within the debt space. So the first thing, and the first key finding that they have, is that the estimated liquidation value of PP&E and working capital is 23% of book assets. So previously, when people have thought about capital structure and collateral values, they might use PP&E, they might try to adjust it downward based on some prior studies of liquidation, but we never really had industry-specific detailed information about liquidation values that come from Chapter 11 findings, where these are, all these liquidation values are pretty specific. And this liquidation value, seems pretty small. So if we think about a borrowing constraint that's theta K, 23% seems pretty small. If you include cash, that number goes up, kind of almost, sort of goes up significantly. And that would be 44%. So I think that'll be an interesting question to think about, whether or not cash should be included. In addition to those liquidation values being kind of a small fraction of plant, property, and equipment, 50% of firms with positive leverage and 75% of non-investment grade firms have debt greater than their liquidation value. And including cash, those numbers go down to 34% and 63%. But still clearly, modeling borrowing constraints as some fraction of capital alone is sort of not the right thing to do, okay? Of course, based on their findings, which I find completely convincing. They're going to emphasize that there appears to be a pecking order within debt. Firms borrow against standardized liquid assets first. They use cash flow-based debt with weak control next. And then at high leverage levels, they turn to cash flow-based debt with strong control, which can either be in the form of covenants or blanket liens. And there's some sort of ambiguity between whether a blanket lien is a secured debt or not secured debt. So this makes us, sort of need to think about these issues in a more nuanced way. So for microfinance, in the introduction, they're emphasizing this idea that debt based on liquidation values relies on property rights institutions for, increasing debt capacity, and debt based on going concern values would also require monitoring technology. So I still think you need property rights institutions to enforce those contracts, but now you need to maybe monitor to kind of understand what the true going concern or cash flows are. That has implication for capital structure models based on tangible assets. And those are incomplete when we don't include cash flow borrowing or going concern borrowing. And maybe in microfinance and topical microfinance, there's an interesting research question around fintech, whether fintech can encourage more borrowing against cash flows or going concerns based on better information. So I think that'd be super interesting. So with that, let me talk a little bit about macrofinance. And I wasn't sure exactly where to split my discussion. I'm gonna just go through this simple framework that I wrote down, and then maybe talk about the implications sort of at the end. So I'm gonna wrap their talk in the implications for macrofinance, because there is a huge, very important literature on financial frictions and misallocations and their effects on business cycle and growth. And I think your findings have really important implications for that literature. So here I'm writing down a very standard firm maximization problem, where firms are choosing their future capital and their borrowing, and they're just maximizing their equity payouts. they're going to choose the future capital and their loans subject to a no equity issuance or a non-negative payouts constraint. And that's going to be associated with a multiplier gamma. And then we've seen some different borrowing constraints in the literature. The traditional literature on financial constraints and business cycles or growth would put a collateral constraint, and this is, exogenous borrowing constraints. There's a large literature on contracting that would try to microfound these constraints. But the collateral constraint would typically say something like, you can borrow up to theta of the future value of your capital. And there are lots of papers that use that constraint. A cash flow constraint, and that was, I'm not sure when it was first introduced. I saw it in a paper by Buera, Kabaski, and Shin in the AER in 2011, allows you to borrow both against a fraction of your future capital and also against a fraction of next period's cash flows. Now, it seems, and it's a little, this is also, I would say maybe from my reading, a little unclear of, which of these last two constraints is supported most by the data. Is it that they're borrowing against kind of near-term cash flows, or is it they're really borrowing against the market value of the firm? And it would be good to know that, because these are two different constraints. So the last constraint, which honestly I haven't seen, please speak up in the chat if you have some work that uses this kind of constraint or you know of some. But in this with this constraint, you can borrow against a fraction of your future capital value plus a fraction of the going concern value. And which constraints you use will influence both your borrowing and your investment decisions. So we know it's going to influence the dynamics of borrowing and capital accumulation, and also the allocation of debt and capital in the cross section. So, I hadn't seen this model, so I just, took the first order conditions, the envelope conditions, and created some Euler equations to think about how these constraints would affect those decisions. And you get the kind of typical thing where when you're choosing capital, for example, in addition to capital, costing $1 today and giving you some output tomorrow, that capital also relaxes your borrowing constraint today. It increases the no equity issuance constraint today. And then the fact that that capital affects the going concern value means that that going concern value also relaxes the borrowing constraint. And, that lambda phi term is capturing that effect of the going concern on the borrowing constraint. I think, most intuitively, we put that in the denominator with the other costs and benefits, happening today, but it sort of looked too messy. So I kind of left it like that. So I didn't go ahead and, sort of program up this model and solve it and solve all the different models with the different constraints. I actually think that would be a pretty interesting exercise. We have a lot of estimates of the theta parameter on borrowing constraints in the literature, but that parameter, is, if there's model misspecification because the borrowing constraint is misspecified, then we're going to see very different parameter estimates. And, I'm going to, end here, and I'll come back to the, many interesting research questions that I think could use your findings. But let me just say, we see in these Euler equations that capital is going to be valuable, in the standard way for output. It's going to be valuable for collateral. That's kind of been there in the literature, but it's also going to be valuable because it affects this going concern borrowing. And the main difference is going to be that higher productivity is going to impact going concerns, but not necessarily the value of collateral. And so typically when you allow productivity to relax borrowing constraints, you end up with better allocations. And I just want to highlight this closely related paper that I think is very nice by Huiyu Li at the San Francisco Fed. She's a student of Pete Kleinau's. She is using detailed data from Japan to show indeed that leverage rises with firm productivity. So kind of evidence very consistent with what you're finding. just to wrap up what I wanted to say about this simple model, I think, you know, it's interesting to see the different distortions that you get for investment and borrowing, given that, you know, they have these indirect effects through relaxing constraints. But I think, you know, it would be more interesting probably if there was a serious wedge between market and book values of the firm and capital that you would get from things that are not included in, you know, the simple thing that I wrote down, like adjustment costs, not separability, and intangible capital, rents or markups, and risk premium, because we have these sort of interesting facts about you know, leverage cycles that might be affected by firm valuations if we have borrowing constraints that are sort of indicated by the Kermani Ma work. So I think with that, just probably due to time, I should, you know, halt, let Yueran take over. And then, you know, I'm going to come back with, you know, basically a list of research questions in macro finance that I think they could address with their paper, and some smaller comments on what they're doing.
Okay, great. Thanks so much, Andrea. So I'll give the mic back to Yueran to tell us about the tale of two deaths. The two tales of death, sorry. The two tales of death.
No worries. Can you hear me? Thank you very much for having me. It's a great pleasure to be part of this wonderful workshop series. And thank you so much, Andrea, for the kind introduction that very well captures many aspects of the study. So this work, as Mary mentioned at the beginning, is joined with Amir Kermani at Berkeley. He's also here with us today, and he will answer some of the questions in the chat box during the presentation. As Andrea's introduction indicated, the theme of what we do is to present a framework for thinking about the nature of firms' debt. And in particular, we do so by bringing in new data on the nature of firms' assets. And as Andrea mentioned, there are both micro and macro aspects of the study. And at the end, we'll also talk a little bit about our understanding of the various implications of this study for both the micro aspect and the macro aspect. So the essence of debt enforcement is a long-standing question. And we'll start with a simple characterization, which will help us organize the study and also pave the way for understanding the empirical objects that we want to measure subsequently. So there are two broad approaches of debt enforcement, both in the spirit in the academic literature and in practice. One approach is creditors can lend against what one could call discrete assets, which are well-defined, separable and often tangible assets that can be evaluated and, if needed, repossessed on a standalone basis. In this approach, the emphasis is not so much the quality of the business, but the presence and the liquidation value of some standardized redeployable assets, which will be there even if the firm is gone. And the prototypical examples include commercial mortgages, equipment loans, and so on. This notion has often been associated with, this approach has often been associated with the notion of secure debt in the academic literature. As we will explain later, in practice, it doesn't exactly map into secure debt in practice in the US. And the term that creditors often use is asset-based debt or asset-based lending, which indicates the focus on the intrinsic liquidation value of some particular assets, and we will follow their terminology. The second approach is creditors can lend against firms' going concern value as a whole, which can be generated by the firm's operations, human capital, organizational capital, not necessarily encapsulated by some discrete separable assets. And in this approach, the focus is very much the value created by the business, and therefore the monitoring of the firm's performance and actions can be especially important. Creditors often refer to this as cash flow-based debt, and the name indicates the focus on the value created by the firm's operations as reflected by its cash flows. This picture is a, yeah.
Real quick, because I had this question when I was reading the paper, when Moody's reports recovery rates for secured debt, is that asset-based secured debt only, or does that include debt secured with one of these blanket liens that is sort of all the cash flows?
Both. I will explain more when we get to that part of the talk.
Okay, thanks.
And this picture is a simple representation of these two forms of debt enforcement and their foundations. So a typical firm may have some discrete assets like equipment and land, and their liquidation value is represented by this red square. And the firm, as the going concern, can generate a broader set of value that's captured by this bigger blue circle. We may use these shapes as a notational shortcut in the presentation. It is important to note that these two sets of values can be quite different for a number of reasons. One is the well-recognized importance of human capital and organizational capital for non-financial firms, and Andrea has also written about this. And the other, as we will show in the data, is that many of non-financial firms' assets are quite specialized, which can further compress their liquidation values. And of course, which approach is feasible certainly depends on the institutional foundations for contracting. And there has been largely sequential development history from initially very limited enforcement and limited lending to subsequently the development of property rights institutions that helps facilitate lending against tangible assets to ultimately the development of more sophisticated contracts and legal foundations to preserve going concerns to enforce these contracts that helps borrowing against the firm value on a large scale basis. So in this paper, as Andrea's preview mentioned, we will start by measuring these two sets of values, and we'll use these empirical data on the nature of firms' assets to shed light on various aspects of firms' debt, and we'll construct a framework for thinking about several dimensions of firms' debt, including debt composition, the use of covenants and interest rates, etc., as a function of four key elements. One is the liquidation value, and two is the going concern value, not just in normal times, but also if the firm gets into restructuring or possibly creditor control. And three, the amount of borrowing, whether there's any pecking order, do firms go down pecking order in terms of their debt choice. And four is the legal foundation in the background, which in this work, we take it as the US setting with verifiability of cash flows and Chapter 11 restructure. As a short preview of the results, the first thing that we start by seeing in the data is the liquidation value is typically limited, and that includes liquidation value from both fixed assets and working capital. Of course, there are variations across industries given the nature of the different types of assets used in different industries. But for the typical non-financial industries, not just the stereotype of tech companies, but for many non-financial industries, the liquidation value is rather limited. And then it is understandable that with financial development, contracts and legal foundations will help facilitate borrowing against the firm value as a whole. And then we'll show the reflections of these two approaches of debt enforcement in the data in several ways, with debt composition, monetary intensity, interest rates, and other attributes to show these debt attributes as a function of the key elements I just mentioned, and also some pecking order along the way. So given the limitation of lending purely against liquidation value and the importance of lending against going concern value, it's natural to think that when you care about going concern value, you would care a lot about the firm's performance and making sure the firm has good performance and takes the right actions, in which case creditor control and monitoring can be important, but monitoring doesn't happen in a vacuum. Creditors need foundations for enforceability. We're showing the data that it seems what's quite foundational for monitoring is the going concern value in restructuring, possibly under creditor control, not necessarily the liquidation value of the firm. And then finally, we will integrate several aspects of the key empirical results, debt composition, and the use of covenants in a simple model that aims to be parsimonious, but can most closely follow the US institutional settings and to flesh out how the arrangement helps facilitate ultimately borrowing against the firm value as a whole. There is a vast literature on debt covering several aspects. Many of these papers are quite famous and familiar to people, and what we will bring in to start with is new data on the nature of firms' assets in combination with detailed data on several aspects of firms' debt. So now let me get into the details of the data. As we mentioned, one of the key objects we want to measure is the liquidation value of different types of assets across industries. As Andrea also mentioned, this is certainly a non-trivial task. How do we know the liquidation value of different things in different industries? It turns out that a source with pretty systematic reporting is one of the disclosures in US Chapter 11 filings. And as we know, in Chapter 11, firms continue to operate, they don't die. And in particular, as they complete Chapter 11, they are required by law to document the liquidation value of different types of assets if they were to be liquidated in Chapter 7, in which case they would cease operations and sell off all of their assets on a largely piecemeal basis. And these estimates and the reporting allows us to get a sense of the liquidation value across different industries for different asset classes. And in particular, what we will extract from these filings is the liquidation recovery rate, which is liquidation value relative to book value of different types of assets across industries. Of course, ideally, we may want to ask this question to all firms, every firm. What is the liquidation value of all the assets that you have? But that is certainly not possible. The good news is, as we will show through extensive verification, there is quite a bit of consistency in the liquidation recovery rates for a given type of asset in a given industry, often tied to the physical nature of the asset, and therefore one can generalize the liquidation recovery rate reasonably well for firms in the same industry.
So Yueran, and I'm not sure you might get to this, I'm not sure I did see it in the paper, but you have this kind of nice, I mean, it's 16 years of data and you have some really different time periods too, especially when you consider industry cycles. Is that something you will talk about? How
Yes.
that would vary with industry and aggregate conditions?
Yes, in 2 slides. So we first extract this industry level attribute, the liquidation recovery rate, which is lambda, and we will then be able to apply it to a broader set of firms based on their industry, for example, all of firms in the CompuStat universe, and then we can use this recovery rate combined with the amount of assets they have in different categories to construct an estimate of firm level liquidation value for a broader set of firms. And as we also mentioned at the beginning, we also want to know the going concern value, which is to keep the firm as a whole, not break it apart in normal circumstances, which is rather straightforward, but also in the potential situation of restructuring creditor control. This we also extract from the Chapter 11 filings. So for each firm, we have the going concern value measured based on post-emergence market value or the estimate of going concern value in the Chapter 11 plan. And then we can normalize them by book assets at filing and take the average for firms in the same industry to construct another industry level attribute. So now to give you a more concrete sense of the raw data, this is an example of the liquidation recovery estimates from a pretty famous case, LyondellBasell, a chemical company. And the reporting, the summary reporting that you will see is breaking down typically by each asset class. And these correspond to financial statement categories, which is super helpful that The industry professionals have constructed them and summarized them at this level so we can generalize them pretty easily. For this example, you'll see for cash and for inventory, working capital, and fixed assets, what's the net book value and the low estimate, the high estimate, and the midpoint estimate, which are in our baseline analysis. And so we collect these reportings from hundreds of Chapter 11 filings over a span of 2 years. And as a summary, you can see here 2 examples for 2 types of assets, what's the average industry level recovery rate looks like. The first example is fixed asset or plant, property, equipment. For the average industry, the recovery rate is 33%, meaning liquidation value is on average 33% of book value. And that is, of course, quite limited. There are certainly variations across industries, and pretty intuitively on the high end, we see transportation with cars and ships and aircraft, standardized transferable mobile assets, whereas on the low end, you typically see services and various forms of manufacturing. For inventory, the average recovery rate is 44%. And again, there are quite a bit of cross-sectional variation. On the high end, there's retailers, pretty intuitively, car dealers with their car inventory. And on the low end, we have restaurants, food inventory is very perishable, and then telecom and other types of manufacturing. So in the companion paper, because of space constraints, we investigate in detail the determinants of both the level and the variation in these recovery rates. So on average, across industries, you can explain the variations reasonably well, if not quite well, based on the physical attributes of assets used in different industries that we can also measure, for example, their mobility, their durability, the degree of standardization and customization. And also over time, as Andrea just asked, what are some of the patterns as industry condition or macro conditions may vary. So we find that variations in macro industry conditions can have some impact on the recovery rate. For example, if macro conditions are significantly better or industry conditions are significantly better, the recovery rates may increase by, say, 5 to 10 percentage points and vice versa. But they do not seem to substantially change the overall picture of both a reasonably low recovery rate on average and the relative ranking across industries. And one of the key reasons is the natural physical attributes of assets used in different industries are inherently quite different.
So I think, yeah, thanks. And I think one of the reasons that people would be really interested in the time series variation is there, to apply in these models of fire sales. So, how much do these liquidations go down and how can that lead to sort of vicious cycles?
Yeah, so I think based on my memory of the numbers, for example, if GDP improves by 2 percentage points, real GDP growth, then you would expect the recovery rate of the more generic assets to improve by roughly, I think, 3 or 5 percentage points, whereas the recovery rates of very specialized assets don't really move with industry or macro conditions. And the reason, I think, is because it's not useful for anyone. In any case, one example is you can take my glasses. They're not very useful for anybody else in any circumstance because they're very customized to the type of things that I need.
I guess that's interesting because like the study of fire sales that I know the best is Polvino 98 and the JF like aircraft, which is very specialized, but it's exactly a model of fire sales, I guess, because the first best user is someone else in the industry and the industry's in a downturn.
Yeah, so actually on that note, aircraft is a very interesting example because it's industry specific, but not firm specific. It's not really so much customized to a particular airline. It is specific to the airline industry, and those types of assets we do find things that are industry specific, but not firm specific are most subject to fluctuations in industry conditions. Things like cars that are neither industry specific nor firm specific are most sensitive to macro variations because the alternative users are from economy wide, Whereas things that are very customized to a particular firm to begin with, the degree of customization to the firm is high, then it makes it not very useful for anybody else in any situation. Yeah, we do find quite interesting patterns, and we invite you, if you have interest, to also read the companion paper. So we do extensive checks to verify the informativeness of the data to make sure they are consistent with information as much as we can get from market-based transactions and for firms in general, firms in any types of circumstances. So first of all, it's pretty natural to cross-check the data with the actual liquidation proceeds from Chapter 7. The reason we cannot directly use Chapter 7 reporting is most of what we get from Chapter 7 is just a summary number of all receipts realized by the trustee. It's very difficult to get the numbers for each asset category. And in particular, in Chapter 7, they may also abandon some assets if, for example, returning the assets to lenders to foreclose. So you need to do some other estimates as well. But through both conservative and aggressive estimates, following the idea of Boris Welch and Zhu, we find broad consistency, pretty similar results between the total liquidation value realized in Chapter 7 and the total liquidation value reported in these Chapter 11 liquidation analyses. We also cross-check with one particular instance of a very extensive previous study by Raymond Shapiro on the liquidation recovery rate of aerospace manufacturing equipment through auctions data, and they find the liquidation value to be roughly 28% off of replacement cost, which is very close to 32% for the same industry's equipment in our data. And third is what you may have asked, whether firms going through Chapter 11 are special in this dimension. So we have obtained some information from a very large bank about the liquidation value benchmarks that they use for non-financial borrowers in general. So this comes from their experience lending to non-financial firms in many different circumstances. And they say that the typical benchmark for the liquidation value of industrial PP&E, industrial fixed assets, is 20 to 30%. For inventory, it's also very similar to our average estimate. And finally, you could also impute the implied recovery rate from PP&E sales, fixed asset sales of CompuStat firms. So they report the sales proceeds, and then you can calculate the implied book value of things sold. And we find that the levels match and there's significant correlation across industries. Of course, these things are not going to be exactly the same. One is we don't know exactly what's the asset being sold in these instances, and there may be selection other issues. Whereas one nice thing about our data is it captures liquidation value of all the assets that firms have. So now with this data, as I mentioned, if you take the industry level attribute, the industry level recovery rate, one can apply them to firms in the same industry more generally and estimate the firm level liquidation value and its composition, for example, for firms in CompuStat. And this is a summary of the average firm in CompuStat. The total size of the pie is the total book value. The gray area is the amount of cash that a typical non-financial firm has. And the orange area is the liquidation value that you can derive from receivables. This middle one is inventory. So these two combined is working capital, roughly 15% of book value. And then this final area is fixed asset, roughly 9% of total book assets. And you can also see there is a distribution of the liquidation value given the variations across industries we just mentioned. So the first curve represents the firm level liquidation value coming from fixed assets together with working capital for estimates for CompuStat firms. The middle one is liquidation value including cash, so that shifts it to the right a little bit. And then if you compare this with the industry level Chapter 11 value, you will see that even for almost all the industries, or most of the industries, you will get the Chapter 11 value. If you can preserve the firm as a going concern, that will be generally much higher.
So
Now,
a quick question, because I think you kind of alluded to this, but I think people might be wondering, you know, firms go into Chapter 11 for a reason. It's because in Chapter, you know, they're kind of probably worth more at going concern than liquidation. Otherwise, they would go to Chapter 7. So just briefly comment on why or why not, why this isn't an issue.
Yeah, so well, if you look at the large firms, or most of CompuStat firms, Chapter 11 is the most predominant form of resolution, and therefore we think that Chapter 11 values are especially relevant for firms in this space. And second, to your point about whether firms going through Chapter 11 are special in any ways, so we often get the question whether, for example, their liquidation recovery rates would be different than firms in general. I already mentioned, to the best of our knowledge, the liquidation recovery rates that lenders use for non-financial firms in general is very similar to the picture that we see here. And also a lot of this consistency arises from the nature of assets that firms use in different industries. If you improve macro industry conditions, you can improve the liquidation recovery rates in some industries by a little bit, but it's not going to be give you a drastically different picture. And as Andrea's preview also mentioned, we can compare these liquidation values with the amount of borrowing. This is a heat map of from CompuStat firms where the x-axis is the liquidation value, fixed assets, and working capital. You can include cash or not include cash. It's not going to make a huge difference. And the y-axis is the amount of debt relative to book assets. And the overall picture we see is, as Andrea mentioned the numbers, we have quite a lot of firms borrowing way beyond their liquidation value. Of course, if you also include other liabilities they have, then you will see an even larger chunk of firms borrowing much beyond the liquidation value. So now, given that liquidation value as a source of foundation for borrowing is quite incomplete for many non-financial firms, we want to look further into the debt contracts to see the prevalence of different approaches of debt enforcement and their foundations. So we do so by looking at several aspects of attributes of debt. First is debt composition, which I will explain in more detail in the next slide, and then also monetary intensity. And finally, other attributes like interest rates, and as another reflection of what different types of creditors care about. So first, starting with debt composition, which is a very direct reflection of the usage of different types of debt enforcement, we will partition things first into asset-based debt and cash flow-based debt, and then within cash flow-based debt, things with strong versus weak control. The reason that we partition this way is to most closely capture debt that is focused on the liquidation value of some specific assets, and versus debt that is focused on the going concern value of the firm as a whole. So the first one, which is asset-based debt, represents something that is in spirit most closely related to the traditional notion of lending against tangible assets. They're typically directly secured by some well-defined separable assets to make it very clear that they have exclusive priority over these assets like a piece of equipment. And in terms of procedure, when firms take out such debt, lenders would start by appraising and estimating the liquidation value of the particular assets pledged to them, and which serves as the limit for borrowing. And so by that, you can see that for this type of debt, you can apply the traditional theta times K type of structure, and the thetas are very similar to what we just reported as the liquidation recovery rates. You could use those data as guidance for the thetas for the traditional type of borrowing constraint. But that borrowing constraint applies to this category of debt, not to debt in general. The other category of debt, which is cash flow-based debt, they don't start by appraising the liquidation value of a particular piece of equipment or so on. Their foundation is the value of the firm as a whole. And as I will discuss in 2 slides, they can be structured as both secured through a blanket lien or unsecured. And in particular, we here will then further partition them into things with strong and weak control. The reason is here, when you lend against the firm value as a whole, it's pretty natural that you care about the firm's performance and actions. And some debt, as we know, for example, represented by loans, are much more involved in monitoring and control, given their concentrated ownership and also lender specialty. And there another segment, which is bonds, which is more arm's length, and they're not as involved in monitoring per se. So now I will show 3 pictures of firms' debt composition as a function of their attributes and the amount of borrowing. The first picture shows the debt share coming from asset-based debt. So asset-based debt, things like equipment loans, specifically against those well-defined separable assets, that debt as a share of total debt. For firms with low liquidation value in the bottom tercile, that's the blue dots, and firms with high liquidation value, these are the red dots with liquidation value in top tercile, and also as a function of the amount of borrowing they have. So here we see that for the initial amount of leverage, roughly leverage below 10%-ish, you have a relatively high prevalence of the asset-based debt. So this very simple form of directly pledging a piece of equipment and so on may have some cost advantage in terms of interest rates. And if firms do have such liquid transferable assets, they may start by borrowing against them. But most firms do not find this so appealing once they need to borrow a lot, especially for firms with low liquidation value. And you can see for them, the prevalence of this type of debt declines pretty sharply once they start borrowing more. The prevalence of this type of debt, as we show in regressions in more detail in the paper, also decreases with going concern value. Now, for the middle range of leverage, we see there is an increase in the prevalence of borrowing against cash flows, but mostly guaranteed cash flows in a more arm's length way, represented by bonds. And that is also more prevalent for firms with low liquidation value, for firms with higher going concern value. And then ultimately, when firms get into the range of high leverage, they borrow against cash flows, but now with a lot more creditor involvement and more in the form of loans. And you see a pretty sharp increase in these loans. And in particular for firms with low liquidation value, and in regressions, you can see also more for firms with higher going concern value. And you may have asked since the beginning whether our partitioning is the same as secured versus unsecured debt, and as Andrea also asked whether secured debt, say for example in Moody's analysis, incorporates what types of secured debt. So as legal scholars have noted, the essence of security, at least in the US, is priority. And firms can take priority against different things. Firms can take priority against the liquidation value of a piece of equipment. Creditors can take priority against different things. They can take priority against the liquidation value. They can also take priority against the firm value as a whole, in particular, often through the construction of blanket liens or technically security against substantially all assets. So in this case, you have a secured debt, but the secured debt primarily gives creditors the highest priority claim against the firm's going concern value. They don't have necessarily highest priority claim against the particular liquidation value of anything plush to equipment loan. And vice versa, the equipment loan has highest priority against the liquidation value of the equipment, but they do not have the high priority claim against the firm value as a whole. So roughly a third of the secured debt in the US can be classified as secured cash flow based debt. If you read Moody's or Fitch report, they will give you an explanation that these are 2 forms of secured debt. Victoria Bashnell and others have also written a recent paper partitioning the segment of secured debt into these 2 different segments. And we also show in the paper that these 2 sets of these two segments of secured debt have pretty different empirical properties. For things like equipment loans, their prevalence is increasing in the liquidation value and so on. But for these blanket liens or cash flow-based secured debt, their prevalence, both in debt shares and the levels, are decreasing in liquidation value, and their prevalence is increasing in going concern value. And these are the opposite, the exact opposite of things like equipment loans, and but are similar to the behavior of cash flow-based debt in general.
So, Yueran, just a question kind of on this segment. In the paper, you use the language, there's a slight pecking order, and in the introduction, it was some pecking order. And I'm kind of wondering, like, looks kind of like pecking order. So what does that slight or some mean?
Yeah, so, well, one reason for that term is you see this type of debt is still being used in the high leverage range. It's not that you do not, especially if you look at the debt level plots, like I think we have one, the level still keeps increasing. It doesn't completely plateau, but it plateaus somewhat. Another question that people often ask is whether firms exhaust their liquidation value from equipment and so on before they move on to the next type of debt. The picture in the data is not completely, and I think to the best of our understanding is you may have liquidation value from some rather illiquid assets, and that's quite common as well. And those very illiquid specialized things are not often pledged directly. Firms do not find it advantageous to pledge very specialized assets.
I see. I guess the first thing could it be explained by like fixed costs to adjusting your debt composition that you would have some of this other kind of debt around at high debt levels. One other question, and this might not be the exact right time to ask it, but I'm very curious, and I hope I didn't miss it, but the going concern value, how does that relate to the market value, say, 1-2 months before entering into Chapter 11? It's sort of like this discount to like PP&E book assets versus liquidation value. There's going concern value. There was, some firm value, market value of equity plus debt, and now there's some going concern value in Chapter 11. How does that compare to, the trajectory of that firm value prior to entering bankruptcy?
Yeah, my best memory on the going concern value that we measure here, which is the going concern value when you emerge from restructuring versus the going concern value going into restructuring. I think they're possibly correlated, but I cannot recite on top of my mind with the exact level of correlation. We also find that the going concern value and the liquidation value are not strongly correlated. So some industries may have many standardized assets, but that doesn't necessarily mean they necessarily have a higher going concern value and vice versa.
I guess I'm thinking when I used to teach corporate finance, I would, we would always say the indirect costs of financial distress are higher than the direct costs. The direct cost is like the difference between the true value, what you're selling your thing for, and the indirect cost is like your employees don't want to work there and your incentives are all messed up. And so the firm value is lower. It seems like you might be able to give us an idea of what those are.
Yeah, so that's a good question. I think there are also, as we see in the data, cross-industry variations in how much going concern value can be retained in restructuring. Some industries have more contracts with customers and suppliers that are sensitive to the uncertainty of restructuring. Some industries have more robust relationships, and they also play a role in these cross-sectional variations in industry level going concern value in restructuring. Now, moving beyond debt composition, another reflection of how much creditors care about monitoring is the covenant tightness. And here we measure it following the procedure established by Justin Murphy's prior work. And we also see that covenant tightness, which in this measure is the estimated probability of violating a covenant, that becomes tighter when firms have higher leverage, and also tends to be tighter when firms have lower liquidation value and when firms are in industries with higher going concern value. In those cases, creditors care more about monitoring and preserving going concern value. Finally, interest rate, another reflection of what creditors care about. you can also see pretty different behavior between asset-based debt and cash flow-based debt. For asset-based debt, there is substantially lower interest rates for firms with high liquidation value. That is not the case for cash flow-based debt. So asset-based debt interest rate, even if you absorb the same firm times control for firm-specific condition and other issues, asset-based debt interest rates is especially sensitive to liquidation value. That's what they care about. That's not what cash flow-based debt cares about. And in the paper, we also talk about debt recovery rates in default. So asset-based debt, their priority and their payment primarily depends on the estimated liquidation value of things pledged to them. Even in Chapter 11, even if the firm is not literally liquidated, liquidation value that is estimated is still the foundation of their payments. That is what we see in the data. For cash flow-based debt, their recovery rate is increasing in the going concern value of the firm, but not sensitive to the liquidation value of the firm. So in Chapter 11, you would form an estimate of the going concern value, and they derive payments primarily from that estimate of going concern value. And people also often ask, if you put these two approaches of debt enforcement together, what is the implication for total leverage? And that's also related to the more borrowing constraint type of question that Andrea posed at the beginning. In the data, we find that for firms, for large firms or primarily firms with high positive earnings, there's no significant relationship between total leverage and liquidation value. They have quite a bit of space to borrow against their cash flows. Whereas for small firms and firms with negative earnings, they do not have so much verifiable cash flows to show to creditors, and they primarily need to rely on tapping into the liquidation value, and you see a positive significant relationship between total leverage and liquidation value. Finally, in the last few minutes that I have, we integrate several aspects of the empirical results in a simple model to show an illustration of how creditor monitoring can facilitate borrowing against a firm value. And we hope the model can most closely follow US and legal and institutional arrangements in fleshing out a way to describe the procedure of monitoring. And we will also generate the empirical patterns in our data on both the debt composition front and also on the covenant tightness front. So we will have three main groups of actors: entrepreneur, informed investors, and uninformed investors. We carve them this way because we want to highlight informed investors to show the role of creditor control. And the contracting environment is, you have entrepreneurial effort that is important for firm success, but not contractable, a standard moral hazard setting like Homes from Tirol. And then we have payoffs and financial performance that are observable and contractable, like in the US setting. And the contracts will be able to write contingent on signals of performance, and that is to model the idea of covenants. More specifically, the model has 3 dates. The first date is the entrepreneur needs to raise fund of unit 1 for simplicity to support the investment project. The entrepreneur can raise financing from internal funds, W, informed investors or uninformed investors. And then the entrepreneur will choose a probability of success that's driven by the entrepreneurial effort, which is costly to the entrepreneur, and the effort is not contractable. The informed lender, if the informed lender is present, can decide how tight to set the covenant essentially, which governs the probability of getting to the state of the world where the informed lender will exert monitoring and control. What that is shown in the intermediate step. So at time 1, there is going to be a publicly observable and contractable signal, which is represented by S. That's a noisy signal of the effort. That signal, once observed, if that is below the pre-specified threshold S bar, then informed investors can come and intervene. So the key for their intervention is they can essentially stop, meaning turning the firm or pushing the firm towards restructuring, which is the Chapter 11 in a way. and the restructuring value is represented by Q, in that case equity, where the original entrepreneur would be wiped out. The informed investor will decide whether to implement this intervention. If the informed investor allows the firm to continue, then it continues. Or if the covenant is not violated, or the covenant is not tripped, then the firm continues. If you continue until day 2 without intervention, then there is a probability of success, P, that's driven by entrepreneurial effort, and then the probability of failure, which for simplicity can be modeled as liquidation, and then investors and the entrepreneur get paid eventually. So what's the key for this? The key is to show that through this contracting contingent on the measurable and contractable signal, informed investors can use the intervention, which consistent with the data seems to be restructuring of the firm. This intervention can motivate and implement high effort. So the informed investor ex post needs to make sure that we need to make sure that they choose the right form of intervention. They intervene if the present value from continuing is lower and vice versa. And then ex ante, we need to make sure that the informed investors have the right incentive to get involved to commit to monitor. So with this very simple description of
you have like 2 minutes. So.
Yeah, thank you. We are almost done. We can generate the empirical patterns that we observe in the data. For example, that monitoring intensity is going to be higher when leverage is higher, and when liquidation value is lower. That monitoring intensity can be reflected as the amount of monitoring intensive debt, or can be reflected as covenant tightness, which is the probability of violating the covenant. So these are consistent with the data. We also show that in this model, total debt does not have to be sensitive to liquidation value if monitoring cost is not too high. And the model also matches the data in some more subtle ways. For example, the priority rules, the creditors who are involved in monitoring, the monitoring intensive debt, for example, would have high priority with respect to Chapter 11 value and good state payoff, but they do not necessarily have to have high priority with respect to the bad state liquidation value, which is consistent with the data and which is also a way to provide stronger monitoring incentives. So with that, let me summarize. I think from the data that we have collected, one can see the essence of non-financial firms is not necessarily that they have an abundance of liquidation value. And then when you start to think about debt contracts, a lot of the contracts will have an emphasis of being able to borrow against the going concern, and creditor control can be an important element for this arrangement. And so more generally, if you think about the institutional dimension of the implications, institutions that help firms preserve going concern value helps cash flow verifiability, creditor control would be an important component of financial development. And then as Andrea mentioned at the beginning, if you think about the macro finance aspect of this, this is another way to see that just modeling borrowing constraints, for example, was purely based on the liquidation value seems incomplete, at least for what we have for US non-financial firms. In prior work that's now just coming out with Chen Lian, we have also looked at what the paper is called The Anatomy of Corporate Borrowing Constraints. Again, we see that just borrowing against liquidation value, for example, is 20% of corporate debt by value. And when you borrow against cash flow value of the firm, one standard constraint that emerges is debt to earnings, debt to EBITDA. And this type of constraint would have implications for macro finance dynamics, for example, for the relevance of fire sale amplification when it comes to monitoring. So when it comes to modeling non-financial firms and other dimensions as well. And I look forward to hearing Andrea's comments about additional implications that one could consider. And I very much agree with your comment at the beginning that these different ways for thinking about the nature of debt, the nature of borrowing constraints can also have implications for thinking about productivity and misallocation. Thank you very much.
Thanks a lot, Yueran. So before giving the mic back to Andrea, let me just reinforce that if you guys have questions, please raise your hand, and then we are gonna call on you in the Q&A. So Andrea, please go ahead.
Okay, so just to remind us, kind of the framework that I was using to think about how this new borrowing constraint, which is going concern value, would change what we can learn from dynamic models in macrofinance. I'm just throwing this up here just to remind us. So I wanted to go then to this kind of, I came up with, even larger list of things that this made me want to think about. The first one is really this very important question about misallocation of resources in the time series and cross section, which has been the study of the effect of financial frictions, for quite some time. Just to kind of give you an idea of some of the papers in this area, I mentioned this Wera, Kabaski, and Shin paper, and I have the paper titles in the references that's thinking about this misallocation question from the development side, using two borrowing constraints, or a borrowing constraint that allows the firm or entrepreneur to borrow against not only the capital value, but also future cash flows. I'm not sure about going concern. And actually, when I wrote the problem down and saw that, the firm's future value is showing up in the borrowing constraint, I sort of was like, okay, well, we have to make sure this is still a contraction mapping, but I'm assuming that with all the concavity that it probably is. But yeah, that would need to be confirmed that doesn't introduce some issues. There's Mall's paper that thinks about self-financing your way out of misallocation, but if productivity impacts borrowing constraints, you may get this this better allocation than you would otherwise. And that is the focus of the Lee paper that I presented one figure from. And I'll just mention that in this review article on capital reallocation in the annual review of financial economics that I have with you, we kind of, think about this same question for capital reallocation itself, and you really get more capital reallocation and better allocations and higher capital prices when borrowing constraints can depend on productivity as well as just the kind of amount of capital. I also thought about this literature on collateral values and overinvestment leverage cycles. This is a big deal even in the housing literature. Some people explain house price bubbles with this idea that you have borrowing constraints that depend on house prices, and then house prices go up and you can borrow more. I'm sure Amir is very familiar with that literature. But we know that even in the housing market, lending has debt to income constraints, and probably does depend on sort of the future value of the person's wealth or income. There's this interesting fact. It's highlighted in a recent paper by Adelino, Shore, and I believe one other co-author, and I apologize for not having that in the references, in the context of the housing market, where they're kind of highlighting this fact that we sort of knew in the corporate sector, which is that, book leverage ratios vary very cyclically. So book leverage ratios, go way up when market values go down, but market leverage ratios, and there's also a paper by Tobias Adrian and Hyun-Shin kind of showing this. Market values are more stable because firms seem to borrow more when the market value of assets is high. And I think that this model could be a way maybe of thinking about that. Probably also has implications for modeling of default. Of course, this is a lot of information about recovery rates. I have heard it argued that variation in recovery rates aren't super important for bond spreads because it's all default, it's a small default probability multiplied by a small variation in recovery rates. I'm not so sure that I'm not really super convinced by that argument, and I think that this could have implications there too. We have this growing intangible capital as a fraction of total capital, and that presents us with a very interesting question about, how these kinds of firms can be financed. We had a lot of financial innovation in the mid-90s with equity financing through VC and PE of new types of firms. But here we see that this sort of more traditional debt financing can work even with these sort of new economy firms. The lending channel of monetary policy, we know interest rates will affect both collateral values and going concern, so that seems important there. And then I just want to conclude with, I really would be very interested in, kind of the time series variation. Does this going concern type of lending, we see a lot of the paper being about the cross section of using asset-based lending versus cash flow-based lending. Does that also vary, with industry or aggregate cycles? Because we do see a lot of variation in financial constraints, and maybe your kind of insights can help us to understand why that might be. So this is just a quick figure from a paper with Tyler in the JME that plots the aggregate, our estimate of the aggregate cost of external finance. So this is just to show that that cost is, high when we have recessions, and it can even go negative if we have a super big boom in valuations. And so I think this kind of idea that going concern lending might occur more in certain times, not only certain industries or certain leverage ratios, certain firms could help us understand that. Kind of similar focus. This is new work with Huifeng Cheng and Adrian Deverness. This is the sensitivity of investment rates to credit spreads. And, this is how, these are all, negative numbers getting more negative. And so this is how much higher credit spreads reduce your investment rates. And we can see that, it's a much, there's much more of a reduction in investment rates with high credit spreads sort of in bad times, and also in the cross section for firms with higher credit spreads. Concluding with the smaller comments. So this cash question seems important for the liquidation values because it's such a big shift in the numbers. So one question I would ask is, does the cash disappear in Chapter 11? Like, is that why we shouldn't include it? Do they burn through it? And I think you can answer that question, with balance sheet data. I already talked about the time effects on liquidation values. I'll mention just because, having worked on leases, and I'm not sure, who is pushing you to talk about leases in the paper that are kind of, seem to be an important but ignored part of the debt space. You guys are kind of concluding that, not so important or don't change your results. The only thing I'll point out is that leases, this is rental payments to measures of debt capital. And if you just look at, kind of the top row here, you can just see this is by size decile with the smaller firms on the right, that leases are just, they're one of those types of financing that is kind of expensive, probably because the ownership of the capital is not efficiently with the person who's using it. And so that could explain, if you're looking at large firms, why leases may not be as important, but we think small firms are the most borrowing constrained. So, they still might be important for, kind of overall debt considerations. But, really an aside for the paper, super fascinating, and we should hear from, everyone else.
Great, thanks so much, Andrea. So Yueran, do you want to respond to Andrea and go over her comments a little before we go to questions?
Yeah, so I would just briefly respond to 4 aspects that Andrea mentioned. It's a really rich discussion, and thanks again, Andrea, for these very helpful suggestions, and which point to many fascinating questions to study in the future for this literature, both the micro and macro aspects of it. For collateral value and overinvestment, I think that's a very interesting point. In my previous work with Chen, we noticed an interesting contrast, for example, between US firms and Japanese firms. Japanese firms in the early 90s, when Japan had their real estate boom, were very well known to have loaded up on real estate assets, borrowed a lot against their real estate, because in that period in Japan, borrowing against real estate or fixed assets in general is the primary form of borrowing for Japan, and then we saw pretty different dynamics. They were substantially affected by the real estate value when real estate value declined. This type of real estate driven boom and bust did not seem to happen for large US firms in the US housing boom bust cycles, whereas the action was primarily on households who borrow against real estate. So I think it's quite interesting that in different countries with different forms of different prevalent forms of borrowing and prevalent forms of borrowing constraints, you can see pretty different dynamics of firms going through real estate cycle. Intangibles also a very interesting point, and which is now a growing and very lively literature. One of the things we find here is the liquidation value coming from physical assets themselves are not that much to begin with. So the liquidation recovery rates of fixed assets is kind of low to begin with. And then if you have a rising intangible, the liquidation value may not shrink that much, given that you are starting with a pretty low starting point. And coupled with that, in the US, there is reasonably good legal foundation for borrowing against going concern value if you have verifiable cash flows. So it is quite interesting to understand the implications for thinking about what makes intangible special. And finally, time series variations, I think it's also a very interesting dimension. One of the reasons that it's not so much highlighted here is we look at debt composition in terms of debt outstanding. That's a very slow moving object, so it doesn't fluctuate that much over the cycle. If you want to look at the cycle, then you may need to look at the issuance margin more closely, net issuance or gross issuance. And lastly, cash, I think there's quite a bit of work recently showing that cash is more discretionary in terms of how they're used. So, and also in most corporate lending, they're not directly taking cash as collateral if you borrow against specific assets. So we use cash as a control, and the key element of liquidation value. And I think it's a good suggestion. We can see how frequently firms could burn through their cash. Lease, very interesting as well, especially now we have a lot more new data coming from the new lease accounting rule that requires reporting of leases. We do find that there are substantial cross-industry variations in the importance of lease. For, in particular, retail lease is quite a big part, and a lot of small firms are also in the retail segment, whereas for firms in, for example, manufacturing, lease doesn't seem to be that substantial because many of the assets are customized and cannot easily be leased. And interestingly, even for airlines, if you look up for example, Southwest, I think 20% of their aircraft is leased, although they have pretty standardized 737, which is kind of interesting to me. So I think there are many interesting questions to study, and thanks again, Andrea, for putting everything together in this very nice and rich format.
Okay, great. So given the long discussion, so I don't think we have a lot of time for questions, but I think we want to ask one. So Narayan Buluslu from Bank of Canada, can you please ask your question?
Hi, that was a very interesting talk. The question I had, which Amir partly responded to, was if we should think of these numbers of recovery rates as being specific to firms that underwent Chapter 11. And I think Amir's response was that we should think of capital as more industry specific and not firm specific. But I'm wondering if managers have a role to play in choosing not to take care of assets that are, and that may be the reason why they enter Chapter 11 in the first place. So I was wondering about how representative these numbers are we should be thinking about when we think about recovery rates for other firms in the industry.
Yes, as I mentioned in the talk, we have done our best to collect information from additional settings to verify that these numbers generalize reasonably well in the same industry. For example, as I mentioned, from the information provided by lenders at a very large bank, the liquidation recovery rate benchmark they use for industrial PP&E is 20 to 30%. The average in our data is 33%, so it's very close. We also verified with them the benchmarks they use for inventory and receivable also turns out to be very, very close to what we have. So this is very consistent with the liquidation value benchmarks that lenders use when they lend to non-financial firms in general. And I think what Amir explained to you, I haven't read the chat, one of the reasons for quite a bit of consistency in the same industry is because the physical nature of assets used in different industries drive a lot of the variations in the recovery rates. So we have measured the physical attributes of assets. We find that they explain at least 40%. Just based on the things that we can measure, they can explain 40% of the variations of the asset liquidation recovery rates across industries. So, and the low level of recovery rates in part comes from the fact that non-financial firms' assets are not easy to transport. The transportation cost is pretty high. Some of them are not very durable and reallocation takes time, and many of them are customized. So based on the information that we have tried our best to collect, there is quite a bit of consistency across firms in the same industry. And again, we do acknowledge that variations, as Andrea mentioned, in the time series, when you have fluctuations in macro and interest conditions, can have some impact on the recovery rates for sure, but they do not seem to have it to make the numbers drastically different. And finally, to your point, whether firms get into Chapter 11, for example, because the asset value declines, I don't think that's the case. In most cases, non-financial firms, I don't think they get into restructuring because their particular fixed assets have lower value. Like take retailers as a recent example, they get into Chapter 11 because their business model is challenged. Their going concern value may may experience some issues because of the mismanagement and so on, not so much because their real estate has depreciated in value or their inventory, merchandise inventory has depreciated in value.
Okay, great. Thanks so much to Andrea and to Yueran and to Amir. We're looking forward to seeing all of you October 19 for our first mini conference. Thanks guys for coming.
Thank you. Thank you again for organizing this.
Thanks, guys.